Hello and welcome to the Money Show, your one-stop destination for all your personal finance queries. I am Kavita Thapalial and we have lined up a power-packed show, and here's what you should expect on the show today. First up, in this week's Meet Your Fund Manager segment, we will meet ICICI Prudential India's Opportunities Fund Manager Roshan Chutkey. Next, if you are a travel freak and love exploring different places, then our second segment is for you. We will talk about travel insurance and get all your questions answered with Manas Kapoor, Product Head, Travel Insurance, PolicyBazaar.com. And finally, on our last leg, we discuss about REITs and InvITs and how they will be taxed in the new financial year. We will also throw up on the counter to get your portfolio strategies checked. All of it by Feroz Aziz, Deputy CEO, Anandati Private Wealth. So do send us your portfolio queries on our WhatsApp number, which is 865-797-4571. You can also send us your queries on our email ID, which is themoneyshow@etnow.tv. So that's the lineup for the day. But then let's get you the top headlines of the hour. Ends the day on a flat note after 5 sessions of gains. Tata Motors, ONGC log in strong gains. Realty Index emerges as the top sectoral gainer. Tata Motors cruises along in the top gear on the back of robust JLR sales in Q4. Goldman Sachs upgrades the stock to buy from neutral. Titan, meanwhile, sees a lackluster trade despite robust growth across segments. ET Now Newsbreak confirmed Japan's MU Ionic Solutions Corp signs deal with Neogen Chemicals. Neogen to obtain license from MU for technology to make electrolyte solutions at its plant in India. SkyMed releases a worrying forecast for the year 2023, expects upcoming monsoon to be below normal to the tune of 94% of long period average. India dismisses UK media reports saying it had disengaged from trade talks with the United Kingdom. A British diplomat in Delhi confirms that trade talks between the two countries are on. Chinese fighter jets simulate sealing off Taiwan in third straight day of drills. This time, an infuriated China has also used an aircraft carrier. All right, so let's begin the show. And on the Money Show, we make sure that we just don't talk about investing in mutual funds, but also help you meet the brains behind these funds. And in this week's Meet Your Fund Manager segment, we have on board Roshan Chutkey, Senior Fund Manager, ICICI Pru India Opportunity Fund, ICICI Prudential Mutual Fund. And let's take the discussion forward and understand about this fund and its investing mantras and top themes for this particular sector. Thank you so much, Roshan, and good evening. Welcome to the show. Today we're going to talk about India Opportunities Fund that you handle. And before I get into the details of the fund performance and the kind of structure it has, let's just talk about thematic fund because it belongs to that category. Broadly speaking, what kind of thematic funds are available and how different is your fund?
Thanks for having me on the show, firstly. If you look at the India Opportunities Fund as such, this is a special situation style of investing that we adopt in India Opportunities Fund. Essentially, to give you some bit of a background here, there's this famous fund manager, famous investor known as Anthony Bolton, who ran Fidelity Special Situations Fund in UK for about 28 years, from 1979 to 2008. And very successful at that, about generating about 19% CAGR returns. Right? At some point in time, it was the UK's largest fund, open-ended fund. And we don't have this style of investing in India. And this product gap is precisely what we are filling in through this India Opportunities Fund. It's a special situations investing that we follow, like I said. Now, what is special situations investing? Essentially, special situation is any situation which is causing the company some sort of a problem, right? But the problem is very unique. It's a unique situation that the company is going through. And we broadly, from our experience of managing this fund for about 4 years now, we gather that each of the special situations that a company faces can be categorized into one of the four buckets, one of the four following buckets that I'm going to elucidate about. Right? The first bucket can be something like company-specific special situations. What I mean by that is, say, a company like a large IT services company which went through this whistleblower problem back in the day, or it could be a small cap pharma company which went through this IT rates problem. Right? That is a very company-specific special situation. Moving on, the second category is what we call as the sector-specific special situations. Now, these could be of the nature of auto sector facing semiconductor supply issues, or it could be telecom sector facing consolidation issues. One large player emerges and it leads to the death of many telecom players, right? So that is a sector-specific problem, right? The third category is what we call as the regulator or uh, government-led special situations. Now, what are these? These could be of the nature of OMCs absorbing the increase in international oil prices and seeing a sudden dip in their marketing margins, or it could be telecom sector facing AGR related issues, or it could be IMO mandating that ships cannot use high sulfur furnace oils, right? So these are all sector or rather regulator driven special situations. And the fourth category is what we call as the macro driven special situations. These could be of the nature of, US China enter into this trade war because of which you see metal prices crashing big time, right? Or it could be Brexit leading to a large auto major facing problems in UK market, their investment plans getting derailed. All right. So these are macro driven special situations, right? Broadly in our experience, like I said, any special situation can be broadly categorized into one of these four buckets, right? These are not run of the mill problems. It's not an earnings miss problems you're talking about. We're talking about a very unique problem, which is not recurring often, right? And whenever such a problem happens, what tends to happen is the stock invariably corrects, right? And your price point becomes very attractive if you want to invest into that particular stock, right?
Right. So based on these factors, you're trying to tell me, based on these factors and the valuations which might have gone cheaper at that time, you pick up companies which have a better and brighter future?
Absolutely. So the upside is fairly limited, and in our assessment, if we believe at that point in time the downside risk is fairly limited based on a special situation, the risk that a special situation throws up, we go ahead and invest in those companies. Right? It's a high return, high risk scheme, right, from our stable, uh, and the weight of the particular stock in the portfolio is decided based on the number of risks that a special situation throws up. For example,
Roshan, talking about the current scenario and the four situations that you just laid out, that you just explained, what exactly are the current situations or triggers that might just classify into these 3-4 types of scenarios?
Yeah, for example, let's say you have these the recent budget announcement where life insurance companies were not allowed, not were asked for the policies with greater than 5 lakh ticket sizes were asked to for the investors had to face marginal taxation rates, right? That's a special situation which is in the third category, right? If you look at the injectables business, the pharma companies which do injectables business, they're seeing significant competition, right? That's again a sector-specific problem, right? If you look at a biosimilars company, which is facing a very company-specific problem wherein it has to reduce its debt, bring down its leverage, so as and in the process it is selling a significant stake in one of its subsidiaries, right? So that's a company specific problem, right? So these are some of the special situations, the current special situations at this juncture.
All right. Let's talk about the current scenario also before I go deep into the fund performance and the kind of risk and reward ratio investor needs to understand before investing in a theme like this. How is the market looking to you? How are you reading it?
See, from a market standpoint, market view perspective, while while there has been significant correction, the correction has been for a reason, and that is largely to do with the global slowdown, right? When you have global slowdown happening at a time when the interest rates are fairly high, right? They're not still yielding. We still don't have a situation where we can see them coming off from these levels, where we can say that the peak interest rates have been achieved at. It is better to be a bit cautious uh, while we understand the long term opportunity that the Indian market has for its investors. We got to be a bit more cautious at this point in time and own something like sectors like utilities, telecom utilities, power utilities, pharma sector, which has been a rank underperformer and is fairly resilient in terms of its business conditions, right? Large liability franchises which can withstand the challenges that these cautious global slowdown brings about, wherein large liability franchises can withstand the liquidity problem, liquidity decline that we have seen in the at the last window, right? So these are some of the sectors that we are very positive about. Uh, we are negative about sectors which are more consumer oriented, consumer focused, because as we believe the big demand conditions will continue to remain weak for some more time to come, uh, right? So from that perspective, we are still negative on cautious at least on the consumer needs.
Okay, Roshan, I really want to understand that how in this fund you actually control the losses in a falling market. The kind of triggers you've mentioned, these are very short to near term triggers, and after that, the market will obviously change the kind of breadth they are into. So, how do you control the losses in this particular fund? Because it's a high risk fund as well, and the triggers keep changing. So does your selection of companies and stocks. How do you manage that?
So, like I was talking about it, there are two aspects to controlling losses, right? One, whenever a special situation happens, invariably the stock becomes attractive. Now, our research focus at that point in time is ensuring what is the stock price baking in. Are all the risks that the special situation throws up, are they all priced in, well and truly priced in or not, right? And if not, what is the kind of downside you're talking about, right? Only when we are convinced that the downside is fairly limited, and if there is any downside, it has to be because of purely irrational market uh, uh, reasons. uh, we go ahead and buy into that particular stock name, right? Now that is one. The other part is, say, like I was talking about earlier, the number of risks that a particular stock presents, right? Let me elucidate this with a point with two stocks. One stock which is a large auto major which operates in multiple countries. Back when we invested into that name, uh, there were multiple special situations. There was Brexit issue. There was a large leverage problem. There was a luxury car market problem that the company was going through, market share problem that the company was going through, right? And then you had capital allocation problems as well. Now, given the number of risks that this large auto major was facing, we said we should contain our weight in this particular stock. Whereas there was this other company from a large corporate house. Again, it's an aluminum manufacturer. This company was being treated. A significant portion of its company's revenue comes from the converter business, whereas it was being treated as a beta play on the commodity, right? The risks we felt were very trivial in the second case, and therefore we went ahead and built a large position. But mind you, in both the cases, the risks that the special situation threw up were fairly contained, right? So the downside risk was fairly protected. We were playing for a large upside, but because the number of risks in the former case were just too many, we said the weight of the position has to be fairly capped. Whereas in the other case, we built a fairly large position, right? So one, because our research says that the downside risk is fairly limited, we control the risk as such, right? The downside risk. And two, by virtue of weight as a weighing mechanism, we again contain the risks that a particular stock can throw up, based on the special situation.
Roshan, in the current scenario, what is the market cap exposure like in the fund?
As in, you mean
The large cap, mid cap, small cap, yeah.
Large cap. So it's a flexi cap fund, right? I wouldn't know exact composition of the large, mid, and small cap, but it's a flexi cap fund. We are as things stand, it's a fairly large cap biased portfolio. I can say that for sure, right? We have a significant tilt towards the large cap. Uh, but then it's a flexi cap fund. It's a sector agnostic fund. The active risk that we seek in this fund is fairly high, right? And therefore, it becomes a high risk, high return fund.
Your top 5 sectors would be where you're heavily invested right now?
Right now would be telecom and power utilities,
Okay.
right?
Okay.
Then we have exposure to pharma companies, and we have exposure to large liability franchises.
Trajectory for these sectors in near term or maybe 2 to 3 quarters is how, according to you?
The prospects still look great for these names, right? The names that we own, right? We believe this should also provide downside protection at this point in time. Not only is there upside that these stocks present, but they should be less volatile compared to the rest of the market, right? So though it's a high risk, high return fund, given the market conditions, these stocks should, because they are resilient businesses to the market conditions, these stocks should do quite well, is in our opinion.
Numbers, the earning numbers are of not much concern for you?
Sorry, just repeat that question, please.
The corporate earnings or the earning numbers, which will be released now in a few days, we'll start seeing almost all of them coming up with their numbers. So that's not of concern for you?
Yes, I mean, there could be volatility in some of the corporates, particularly for the ones which are linked to the consumer, right? Consumer-facing sectors could see a reasonable volatility in their performance. But the ones which we have in our portfolio, like the utilities businesses, should have fairly defensive earnings profile, and which have defensive earnings profile should be okay in terms of their earnings performance in our opinion.
What should be the return expectation from an investor's standpoint?
I can't talk about return expectations, right? I mean, but the way I can talk about the investment philosophy. See, we have a very well laid out process, I believe, in this fund, right? We are investing into names when they have crashed, when they have not done well, right? Therefore, the downside risk, if our research says the downside risk is fairly limited, we are playing for a large upside, significant upside. So we haven't made too many mistakes in terms of our stock selection thus far. The experience we have given a very favorable experience to our investors. But we cannot. I would like to also urge at the same time that we cannot comment on future performance based on the past performance.
But then what kind of a risk appetite or a risk profile investor needs to have this particular fund in their portfolio?
It's a like I said, it's a high risk, high return portfolio scheme, right? So one should one should not invest. If it depends on the investor's risk appetite, so to speak. Right? If one is looking for a high risk, high return kind of a category of investment, then certainly this fits the bill. And it's a long term. I would say one should be positioned in this fund for the long term returns. One cannot come in and expect returns within a year's time because we invest into special situations. What tends to happen is special situations ensures that the stocks are out of favor for a considerable period of time, right? So stocks don't do well for long periods of time, and then suddenly over a say 2 to 3 year period, the returns start to come in because you are investing in stocks and they are going through their difficult phases. So by design, this fund is suited for long term investors, just not for 1 year return seeking investors.
And how much should be the portfolio allocation to such a fund? 5 to 10%, or maybe more than that can be given?
Depends on the investor risk appetite, right? If you are, I would say, I'm not an expert on this bit, but if you are a 25, 30-year-old who is investing, probably you can have a higher allocation to this fund, right? And in general, I would say investors should not dabble into too many mutual funds in their portfolio. They should have a concentrated set of funds in their portfolio, maybe 5 to 6 in number, because a fund itself is a diversified set of stocks. I mean, right? So uh, there should not be. I mean, if you're investing in too many mutual funds, what tends to happen is the overall return could be more like market return. Right? Choose your 5 to 6 funds, and maybe depending on your risk appetite, have a proportionately higher or lower risk appetite to a fund like this. Invest allocation to a fund like this.
The expense ratio of this fund?
These are details which are available on the
Sure.
fund fact sheet.
All right, Roshan, thank you so much for being on the show today and explaining all aspect of India Opportunity Fund that you handle. And as Roshan also mentioned, high risk, high return, one needs to have a longer term horizon in order to be invested in this fund. Thank you so much, Roshan, being on the show today.